You are scrolling through your brokerage app. A stock catches your eye. Maybe the chart has been climbing for months. Maybe a friend keeps mentioning it. Maybe every finance creator suddenly has a video about it. You pause for a second and ask the question almost every investor asks. Should I buy this? That sounds like the right question, but it is actually too early. Before you ask whether you should buy the stock, you need to ask a sharper question. What growth is this price already demanding? Because a stock price is not just a number sitting on your screen. It is a claim. It is the market saying, for this price to make sense, this company needs to grow by this much, for this long, and still be valued like this at the end. Most investors never translate that claim. They look at the brand. They look at the chart. They look at the price-to-earnings ratio. Then they make a decision based on a story. In this video, we are going to replace that story with one number, the implied growth rate. This is not a magic formula. It will not tell you the future. It will not guarantee a good investment. But it will do something extremely useful. It will show you what the current price already assumes. And once you can see that, you can ask the only question that matters before buying. Do I believe the company can actually deliver it? Let's start with the idea. When you see a stock priced at $50, $200, or $900, your brain treats that price like a fact. It feels like the stock is simply worth that amount. But the price is really a bundle of expectations. It reflects what investors believe the business can earn, how fast it can grow, how risky that growth is, and what someone may be willing to pay for the company in the future. The problem is that your investing app does not show you those expectations in plain English. It shows you the price. It shows you the chart. It may show you the price-to-earnings ratio, but it does not say, this stock needs revenue to grow 18% a year for the next decade just to justify today's price. That is the translation we want. The implied growth rate asks, starting from today's business, what annual revenue growth would the company need over the next 10 years for today's stock price to make sense, assuming you want a reasonable return? Notice what this does. It flips the usual process. Most investors start with the company story. They say, this is a great company, the product is amazing, the CEO is visionary, the market is huge. Then they try to justify the price. This framework starts with the price. It says, fine, the company might be great, but what exactly is the price asking the company to become? That is a much cleaner question. Now, you might be thinking, is this not what the price-to-earnings ratio is for? Not really. The price-to-earnings ratio can be useful as a quick screen. If a company trades at 20 times earnings, investors are paying $20 for every $1 of recent earnings. That tells you something, but it does not tell you enough. Price-to-earnings ratio is a snapshot. The implied growth rate is a demand. Price-to-earnings ratio looks backward or near-term. It depends heavily on current earnings, and current earnings can be unusually high, unusually low, or not there at all. A fast-growing company may look expensive by price-to-earnings ratio, even if the future can support the price. A slow company may look reasonable by price-to-earnings ratio, even if the price assumes more growth than the business has ever shown. Imagine two companies with the same price-to-earnings ratio of 40. Company A is mature. It already sells to most of its possible customers. Its margins are near the top of what the industry can support. Growth is slow. Company B is earlier in its market. Revenue is smaller. Margins are still expanding. The addressable market is much larger than the current business. Same price-to-earnings ratio. Very different reality. The same multiple can be dangerous on one company and reasonable on another. That is why you need to translate the price into a growth requirement. Here is the simple framework. You need 5 inputs. First, market cap. This is the total value the market is putting on the company today. Second, current revenue. Use trailing 12-month revenue, or the latest full-year revenue when that is the cleanest figure. Third, your target return. In this video, we will use 10% per year because it is a demanding but simple benchmark. You can change it. Fourth, your time horizon. We will use 10 years. That is long enough for business results to matter, but not so long that the exercise becomes fantasy. Fifth, an exit multiple. This is the multiple of revenue you think the market might reasonably pay for the company 10 years from now, when it is more mature. This last input is a judgment call. A mature software company might deserve a higher sales multiple than a grocery retailer. A car manufacturer will usually deserve a lower multiple than a dominant software platform. The point is not to find the perfect number. The point is to use a reasonable range and see whether the conclusion changes. Now the math in plain language. If you want 10% a year for 10 years, The company's market value has to be about 2.6 times higher in 10 years. So you take today's market cap and multiply it by 2.6. That gives you the future market cap you would need. Then you divide that future market cap by your exit sales multiple. That gives you the future revenue the company would need. Then you ask, what annual revenue growth gets the company from today's revenue to that future revenue? That answer is the implied growth rate. For example, suppose a company is worth $100 billion today and has $20 billion of revenue. You want 10% a year for 10 years. You assume the company can trade at 5 times revenue at the end. A $100 billion market cap needs to become about $260 billion. Divide that by 5, and the company would need about $52 billion of revenue in year 10. To grow from $20 billion to $52 billion in 10 years, revenue needs to grow about 10% per year. That is the number. The stock price is quietly demanding roughly 10% annual revenue growth for a decade. Now you can make a real decision. If the company has been growing 25% and still has a huge runway, maybe that expectation is reasonable. If it has been growing 3% and its industry is mature, the price is probably asking for something very difficult. Let's run the idea on familiar names. These are not buy or sell recommendations. They are examples of how to think. Start with NVIDIA. NVIDIA has become the center of the artificial intelligence build-out. Its revenue growth has been extraordinary. Its data center business has expanded at a speed that almost no large company ever experiences. But the market cap is also enormous. So the question is not, is NVIDIA a great company? The question is, what does the price require from here? Using a rounded market value around $5 trillion and recent annual revenue a little above $215 billion, then assuming a generous mature tech exit multiple of 8 times sales, the implied growth rate is roughly in the low 20% range per year for 10 years. That is not impossible for 1 year. NVIDIA has recently grown much faster than that. The difficult part is sustaining that type of growth from a huge revenue base for a full decade. The framework does not say NVIDIA is bad. It says the price is asking NVIDIA to keep delivering elite growth at massive scale. That is the actual bet. Now take Tesla. Tesla is not just valued like a car company. The market is also pricing in energy, software, autonomy, robotics, and optionality. That may be valid, but optionality still has to become revenue and cash flow eventually. Using a rounded market value around $1.4 trillion, a revenue base around the $100 billion area, and a generous future sales multiple of 3 times, the implied revenue growth rate lands around the high 20% range per year for a decade. That means the market is not merely asking Tesla to sell more cars. It is asking Tesla to become a dramatically larger business while proving that its higher-value technology businesses can scale. Again, that is not a prediction. It is a translation. If you believe Tesla can compound revenue near that rate for 10 years and still deserve a premium multiple, the price may make sense to you. If you do not believe that, the stock may be more demanding than the story makes it sound. Now look at Johnson & Johnson. This is the opposite personality. It is stable, diversified, and familiar. Many investors think of it as a defensive healthcare name, not a high-expectation growth stock. But stability does not automatically mean the price is easy to justify. Using a rounded market value near the high $500 billion range, annual sales around $100 billion, and a mature healthcare multiple near 5 times sales, the implied growth rate is around 12% per year for 10 years. That is the surprise. A company can feel safe and still have a price that asks for more growth than its long-term profile has usually delivered. This is why the framework matters. It separates business quality from price expectations. Finally, look at Costco. By normal price-to-earnings ratio standards, Costco often looks expensive for a retailer. It is traded at a high earnings multiple compared with many other retail names. But Costco also has huge revenue, reliable traffic, strong membership economics, and a lower price-to-sales profile than many growth companies. Using a rounded market value around the low $400 billion range, revenue around the high $200 billion range, and a future sales multiple near 1.5 times, the implied growth rate is close to 10% per year. That is still demanding for a retailer, but it is much closer to what Costco has recently been delivering than many people would expect if they looked only at price-to-earnings ratio. This is the lesson. The framework can flip your first impression. A famous growth stock may still be reasonable if the required growth is achievable. A boring stock may be stretched if the price asks for too much. A high price-to-earnings ratio stock may be less crazy when the revenue math works. A low price-to-earnings ratio stock may be dangerous if the business is shrinking. The number does not replace judgment. It improves judgment. So why does almost nobody run it? Because the financial information environment rewards motion, not patience. Brokerage apps show you price movement, daily change, charts, news, analyst targets, and trade buttons. Those things keep you engaged, but they do not slow you down. Financial media works the same way. A headline about a stock surging 20% is more clickable than a quiet calculation about what growth is, already priced in. Influencers work the same way. A dramatic story is easier to sell than a spreadsheet. This is not a conspiracy. It is incentives. Nobody gets paid when you pause, open a calculator, and decide not to trade. But that pause may be the most valuable part of your investing process. Here is how to use this before buying any individual stock. Step 1. Write down the market cap. Step 2. Write down trailing 12-month revenue. Step 3. Choose your target annual return. Step 4. Choose your time horizon. Step 5. Choose a reasonable exit sales multiple for the industry. Then calculate the implied growth rate. After that, do not ask whether the company is exciting. Ask whether the required growth is plausible. Compare it with the company's recent growth. Compare it with the size of the market. Compare it with competitors. Compare it with margins and maturity. Then decide. If the required growth is lower than what the company can reasonably deliver, you may have a fair setup. If the required growth is far above what the business has shown, the stock may need a near-perfect future. And if the answer depends on heroic assumptions, be honest about that. The point is not to avoid every expensive stock. Some expensive stocks are expensive for a reason. The point is to know what you are paying for. Before you buy a stock, run this one number. Not because it gives you certainty. It does not. Run it because it gives you discipline. Every stock price is making a promise about the future. Your job is not to believe the promise automatically. Your job is to translate it, test it, and decide whether it is realistic. Run the number first. Decide second. That order matters. Voice direction, read with a calm but firm pace. Add short pauses after each question. Slow down during formula steps. Avoid sounding like you are selling a stock pick. The tone should be educational and controlled. Compliance line for video description or pin comment educational content only. This is not financial advice. Viewers should verify current market cap, revenue, filings, valuation multiples, taxes, risk tolerance, and personal circumstances before investing.